let's do a pulse check on the Hong Kong REIT sector as we see it in 2026. For years, the whole story has been about distress, panic, and pressure. But now, something's changing. The data is starting to hint at a really crucial shift. We're not talking about a boom, not yet, but it's a stabilization, a move from pure panic to something that looks a lot more like poise. So let's dive in. You can almost trace the change in sentiment back to this one number. Late 2025, Hong Kong retail sales jumped 6.9% year over year. Now, that was the strongest signal we'd had in a very, very long time that the sector might finally be hitting a floor. I mean, for landlords who had just been bleeding out, this was the first sign that maybe, just maybe, the bleeding was going to stop. It was the data point that really started to change the entire conversation. And that really gets to the heart of it, right? Have these huge property giants, after weathering this absolute storm, finally found some solid ground? That's the big question we're going to break down today. And we'll do it by looking at 3 key players, because each one tells a very, very different story about what's happening in the market right now. Okay, so let's kick things off with the big one, the bellwether of the sector, Link REIT. Their strategy lately, well, it's not really about chasing aggressive growth. It's about something much more defensive. It's about building a financial fortress, one that's designed to withstand pretty much any storm the economy can throw at it. And a huge part of building that fortress was this, a massive capital raise. Early in 2026, Link went out and issued $600 million in 10-year notes. Now, this wasn't just about getting more cash in the bank. No. This was a super strategic move, a chess move, designed to fundamentally de-risk their entire balance sheet. So what did that $600 million actually do for them? Well, you can see the impact right here. Before this, about 2/3 of Link's debt was fixed rate. This move pushes that number up into the low 70s. It also, really importantly, extends their average debt maturity out from a pretty short 2.9 years. But the big prize, it seriously reduces their direct exposure to the volatile Hong Kong interbank offered rate, or HBOR. That is a huge deal. But here's what's so interesting. It was a calculated trade-off. See, the coupon on this new debt, 4.875%, is actually higher than their current average cost of debt. So you might ask, why would they do that? Well, it's because they are choosing certainty over potential upside. They are deliberately sacrificing some of the profit they'd get if interest rates fall, all in exchange for stability and predictability. It's like they're paying a premium to be able to sleep well at night. And while they're building up the fortress, they're also planting a few seeds for future growth with this REIT Plus strategy. It's called LREP, and it's a private funds business run by a real heavyweight, John Saunders. The whole idea is to move into a model that's lighter on assets and generates more fee income. Now, it's strategically central to their long-term vision, but let's be clear, this is a long game. It's not a major earnings driver today. Okay, let's switch gears completely and look at our second case study, because this tells a totally different story. This is Champion REIT, and Champion is right at the epicenter of the sector's single biggest headache, the Grade A office problem. Just look at this number. Champion is trading at 0.37 times its net asset value. Let me translate that for you. That's a staggering 63% discount. The market is basically saying that the company's incredible portfolio of prime properties is worth just over 1/3 of its book value. That is a massive signal of deep, deep pessimism. And it's not just the market price. The analysts are feeling it too. This quote from Citi really gets to the point. They see these ongoing, sustained headwinds for office rents, and they're even worried that Champion might have to raise more money in a way that would actually hurt their existing investors. That's the kind of risk that this valuation is pricing in. So here's the bottom line on this one. That 0.37 number isn't just a random figure on a screen. It's the market's verdict. And the verdict is that the challenges facing prime office space in Hong Kong are structural, not just cyclical. This isn't a problem that a simple economic rebound is expected to magically fix. All right, from the office doom loop, let's pivot to our third and final case, Fortune REIT. Because here, we see the market making a much more nuanced bet. It's starting to distinguish between different kinds of property, specifically between office towers and a certain type of retail. Now, at first glance, the story looks kind of similar, right? Fortune also trades at a really steep discount, about 0.4 times its net asset value. So you look at that and you think, okay, both Champion and Fortune are heavily discounted. So what's the big difference in the eyes of investors? And this is where it gets fascinating. The very same bank, Citi, that has a sell rating on Champion, has a buy on Fortune. So what gives? Well, they're pointing to a juicy forward yield of over 7%. And, this is the key, stabilizing operations. The market is no longer just painting the entire property sector with one big pessimistic brush. So the investment thesis for Fortune becomes crystal clear. It's a pure play bet on neighborhood retail. We're talking about the shopping centers that serve people's daily needs, the grocery stores, the pharmacies. This segment is seen as way more resilient, and it's directly plugging into that macro retail sales stabilization that we saw right at the beginning. So let's pull all these threads together. What does this all tell us about the Hong Kong REIT sector here in 2026? Well, it seems pretty clear that the era of just selling everything indiscriminately, the panic, is over. It's been replaced by a much more measured, thoughtful poise. You can really see the three distinct narratives right here. You've got Link REIT trading at the smallest discount, and its story is all about building that fortress balance sheet. Then you have Champion, with the steepest discount because the market is pricing in what it sees as permanent damage to the office sector. And finally, Fortune REIT, which, despite its own deep discount, is seen as a legitimate way to play a retail recovery. So our key takeaways are this. First, the bleeding is stopping. You see crucial metrics, like how much of a tenant's revenue goes to rent, stabilizing around 13%. That creates a floor. Second, proactive players like Link are building those fortress balance sheets to handle anything. Third, and this is huge, the market is getting smarter. It's now discerning between the structural risks in office and the recovery story in retail. And finally, all of this means the entire narrative is shifted. The question is no longer about survival. It's about finding smart, risk-adjusted value. Which leaves us with one final big question. The sector has clearly moved from a state of panic to one of poise. That seems clear. But with valuations for even the healthier players still bumping along near historic lows, you have to wonder, is this period of stability just the quiet before a genuine, broad-based recovery finally begins?